Welcome to this special report on the state of the Australian housing market. Earlier today, CoreLogic released its Hedonic Home Value Index that indicated that Australian housing values continued to drift lower for the third month. CoreLogic's Home Value Index dropped 0.6% over the month, a slight improvement from June when the national series was down by 0.7%. CoreLogic's Head of Research, Tim Lawless, joins me. Tim, 0.6% is the national figure. How did the individual states fare? Tim, 0.6 is the national figure. What about the states? How are they faring?
Well, we've seen the national figure at 0.6, as you say, but there's a lot of variability across each of the capital cities and the regional markets. At a really broad level, the combined capitals index is clearly showing weakness. Values were down 0.8% in July, which was the same level of decline as we saw in June. But across the regional markets, our index was flat. We haven't seen any movement in housing values. In fact, it's looking like regional markets are overly more resilient than what the capital cities are faring. But across each of the capitals, we saw a subtly different trend. In Melbourne and Sydney, we've seen the rate of decline accelerating through July across both those markets. Probably no surprise to see that when we consider, especially Melbourne, the renewed period of lockdown, the fall in confidence associated with the spread of the virus and so forth. Similar in Sydney, even though they haven't progressed into stage 3 or stage 4 lockdowns, there has been some increase in the spread of the virus on top of already weak conditions. But markets like Canberra haven't seen any value fall at all. In fact, Canberra housing values are at a record high at the moment. We saw some stability returning to the Perth market with values only down 0.6% over the month. That followed a more than 1% decline the previous month. And then some of the other capital cities have been generally relatively flat. Adelaide's up slightly, Brisbane's down slightly. Hobart saw a very subtle decline as well. But it looks like most of this weakness is emanating out of Melbourne at the moment, and to a lesser extent Sydney.
Yeah, of course, you mentioned there Melbourne and the and what's happening with auctions as well. I wanted to touch on that with you too. Now that Melbourne's gone into an even more severe lockdown, how long do you think that's going to take for us to start to see that come through in some of the auction listings and auction results, Tim?
Well, we're already seeing it to some extent, Kevin, and probably a little bit more muted than what we saw over the previous lockdown period. The withdrawal rate is one of the signs we look for, any signs of, cracks emerging or vendors losing confidence. And surprisingly, perhaps, the withdrawal rate across Melbourne actually improved last week. We saw about 29% of properties were removed from auctions that were previously scheduled. The previous week, it was up a little bit higher than 40% of auctions had been withdrawn. So it does look like more vendors are willing to test the market. If we look at the clearance rate across Melbourne and adjust for withdrawn properties, so exclude withdrawn properties, we're still seeing, for those properties that actually proceeded to auction, about 80% were actually selling either before the auction, at the auction, or after the auction. So it looks like for those vendors that are willing to take their property to the marketplace, they are still getting a result or a positive result. It's more clearly opting to either sell before the auction's actually proceeding, or some are now withdrawing their property from the market.
Tim, in your release that came out today, the Hedonic Home Value Index, you described the market as, I think, or the change in the market is fairly orderly. What are the factors that are impacting that, Tim?
I think there's a variety of factors. The main ones are really obvious. It's the fact that there's a lot of stimulus across the economy. We're seeing some level of income for those people who have lost their job is still coming through. We're seeing those who are distressed don't have to pay their loan repayments at the moment. There's a mortgage repayment holiday, of course, which is keeping urgent sales off the marketplace, at least to some extent. And we also have record low interest rates. So all of those factors are clearly providing some support to the market. But less obvious than that is still the fact that we are seeing relatively low advertised stock levels across the market. Even though fresh listings are back to about where they were last year, we are seeing a very strong rate of absorption, which means the total listing numbers are still well below where they were a year ago. The only capital city market that has an elevated level of listing numbers compared to, say, last year is Melbourne. And that's starting to shine through in some weaker conditions across that marketplace.
Yeah, a little bit later in this report, I want to ask you about what you're seeing in terms of agent activity. It's always a good indicator about where we're headed in the market. But before we do that, I'd just like to ask you about the fiscal support that you mentioned there. What do you see the market being like when that starts to come away, Tim?
Well, it's a little bit better now that we're not facing a fiscal cliff, as many were describing it at the end of September. Previously, that was when we were due to see both JobKeeper be removed and JobSeeker start to wind down. Both of those levels of stimulus have now been extended, and we've also seen home loan repayment holidays extended out to the end of March of next year. But clearly, when we do start to see that level of stimulus tapering, which will be from October of this year, we start to see it winding down. I think that's where we will start to see potentially some more urgent sales coming on the marketplace. Those borrowers who are in a distressed situation are probably already having conversations with their lender, and those that don't think they are going to be back in a position to make their repayments by the end of March next year are probably already starting to plan for offloading some of their assets. So it'll be interesting to see how it pans out, but I think that will be the real test of the market's resilience. To date, as we talked about, Kevin, the market decline has been very orderly. We've only seen housing values fall by a little bit less than 2% nationally through this coronavirus period. In the worst hit market, Melbourne, values are down about 3.5%, which in the grand scheme of things isn't really all that much. So I think we will see the market being tested for its resilience later this year when we do start to see stimulus winding back.
Are there any signs already, Tim, of a distressed stock starting to come through? You mentioned there about a number of people maybe already talking to their lender about getting some sort of relief. Are you seeing any signs yet?
No, and this is something that doesn't really show up in the data as well as you might hope. So typically when a property is being sold under a distressed situation, it wouldn't be advertised as such unless they're using that as a marketing tactic, which generally doesn't work all that well. It doesn't show up in the bank numbers just yet. We'd typically be looking for something like a rise in the 90-day arrears numbers, which the last report from the RBA was still that they remained very low, below 1%. So nothing, I suppose, no evidence, but you'd have to imagine that we would start to see more urgent sales, not necessarily forced sales, but those property owners who may be experiencing distress, particularly investors who might be highly leveraged and have had an impact from their rental income as well as their working income, I think would be the most fragile segment that we should be watching quite closely.
Yeah, there is one area that I know CoreLogic watches very carefully because you get all the data, and that is what agents are doing, their activity in terms of competitive market analysis and so on, as an early indicator about new listings coming on. Can you take us through some of the stats you're seeing there, Tim?
Yeah, absolutely. So based on the RP Data platform, which has about 75 to 80% of real estate agents around the country utilizing it to prepare properties for listing, monitoring that metadata gives us a heads up on how many properties are being prepared for the market. Prior to Easter, that trend in real estate agent activity had fallen by a little bit more than 60%. And then coming through late April and into early May, we were consistently seeing signs of agent activity improving to the extent that now, or really it's from about early to middle of June, we've been seeing real estate agent activities roughly in line with where it was a year ago. So fairly normal, even though 2019 is a low benchmark to refer back to. But in Melbourne, the last few weeks, we have started to see that level of activity fading. And this was absolutely expected. In the first round of lockdowns, we saw, first of all, real estate agent activity started to fall quite quickly. It's not falling as quickly this time around, but we are expecting if there's less agent activity, that will then migrate through to fewer listings, new listings coming on the marketplace, which in many ways will be a positive thing at a time when buyer demand is probably going to be impacted through the lockdown phase. Having fewer listings in the marketplace is one element of insulating housing values.
Of course, we've seen some good news out of New South Wales just last week about stamp duty. What sort of impact will that have, do you think, on the number of people who may bring their purchases forward, first home buyers, and maybe what impact will that have on the rental market, do you think, Tim?
Well, we've seen time and time again when state governments offer up stamp duty incentives or concessions or discounts, first home buyers tend to react very quickly to those measures. When you combine it with all the other stimulus measures or incentives that are available for first home buyers at the moment, be it the 5% deposit scheme or the home builders grant, the first home buyers grant and so forth, I think there's a fairly strong likelihood that we will see first home buyers taking advantage of those stamp duty concessions. First home buyers are already above average levels across most of the states. They're taking advantage of the fact that interest rates are very low and there is a lot of stimulus in the marketplace. They're not competing with investors at the moment because investors are at virtual record low levels, at least from a participation perspective. So I think it will have a positive impact on the market. From a rental perspective, I mean, this is another element that could impact on this on the demand side. Typically, if you're a first home buyer, prior to that you were a renter or you're at home with mum and dad. So at a time when we've already seen a pretty big hit to rental demand, along with additional rental supply as well, this could spell some further weakness for rental demand going forward.
Tim, thanks very much for your time.
Thanks, Kevin.